Another day, another story. Welcome to this video on international corporate finance, where we'll be discussing the management of financial operations in a global context, including exchange rate risk management, international investment analysis, and cross-border capital flows. As businesses and economies become increasingly interconnected, understanding international finance has become crucial for individuals and organizations alike. The movement of money across borders has significant implications for businesses, economies, and the global financial system. In this video, we will explore these concepts and provide real-world examples to illustrate their importance. Exchange rate risk management. Exchange rate risk is the risk that changes in exchange rates will adversely affect a company's financial position. When a company operates in multiple countries, it is exposed to fluctuations in exchange rates, which can impact the value of their assets, liabilities, and cash flows. To manage this risk, companies can use various strategies such as hedging, netting, and diversification. For example, let's consider a US-based company that has operations in Europe. If the euro depreciates against the US dollar, the company's revenues in euro will decrease, impacting their profitability. To manage this risk, the company can enter into a currency swap agreement, where they agree to exchange a fixed amount of euros for US dollars at a predetermined exchange rate. This will help the company lock in a favorable exchange rate, reducing their exposure to currency risk. International investment analysis. International investment analysis involves evaluating investment opportunities in foreign markets. To do this, investors must consider various factors such as political stability, economic growth, and regulatory environment. These factors can impact the returns and risks associated with investments in foreign markets. For example, let's consider an investor who is considering investing in a company in China. They will need to consider factors such as China's economic growth, the stability of its political system, and the regulatory environment for foreign investors. If the investor determines that the risks associated with investing in China are too high, they may decide not to invest. Alternatively, if they believe the potential returns outweigh the risks, they may decide to invest. Cross-border capital flows. Cross-border capital flows refer to the movement of money across national borders. These flows can be in the form of foreign direct investment, portfolio investment, or foreign aid. The flow of capital across borders has significant implications for global economies and financial markets. For example, let's consider the impact of cross-border capital flows on emerging market economies. If a large amount of foreign capital flows into an emerging market economy, it can lead to currency appreciation and inflation. This can impact the competitiveness of domestic industries and reduce the purchasing power of domestic consumers. Alternatively, if foreign capital flows out of an emerging market economy, it can lead to a depreciation of the domestic currency and a financial crisis. In conclusion, international finance is an essential aspect of today's global economy. Businesses and investors must understand the management of financial operations in a global context, including exchange rate risk management, international investment analysis, and cross-border capital flows. By understanding these concepts and implementing appropriate strategies, businesses and investors can mitigate risks and take advantage of opportunities in foreign markets. Thanks for watching.